All right, hello. Thank you for joining us. I'm Andy Arnold, CEO and Senior Wealth Advisor here at Centerline Wealth Advisors. This is the next episode in our series we like to call Between the Lines. We like to make it easy and hope fun for you to learn about a wide range of topics. We look between the lines and dig deep on many subjects so you don't have to spend your valuable time making sense of new developments. Today's session is about what we saw in the markets in 2025 and a look ahead to 2026. First, some quick housekeeping tips. If you have any questions, please put those in the Q&A sections below on the bar below, and we'll be sure to get to those. Please don't take anything we discuss as personalized investment advice. Investments should only be made in the context of a complete, well-crafted financial plan. Anything less is just gambling, in our opinion. We'll follow up and send you a link to the recording in a few days, just in case you miss anything or want to go back over some important details. Now, Dynasty Financial Partners has been a resource partner of Centerline for over a decade. Not only do they provide some technical back office expertise to us along the lines of technology and compliance, but they also have a team of CFAs and other investment subject matter experts. Their insights have helped us formulate investment solutions for years, and so we wanted to bring them on to hear their opinions as part of our panel. JC Kurtzman and Denise Brackett are here to bring their expertise as holders of the prestigious CFA and CIMA designations. Wealth managers Jeff Wood and Jack Wilson from our team are also here to help with our panel discussion today. So let's get right to it. Welcome, Denise and JC. Denise, do you want to summarize 2025 for us? I know that's a tall order. It was really difficult to figure out. Almost everything went up. So what do you think about that? Seems pretty unusual.
Yeah, I'd be happy to do that. And thank you so much, Andy, and the Centerline team. And thank you so much to our guests for joining us. Again, as Andy said, my name is Denise Brackett. If we do a quick recap of 2025, I think, and I'm sorry, JC, are you sharing the slides? Okay, perfect. All right. So the dominant theme of 2025, I don't think this will come as a surprise to our guests, but it was AI, artificial intelligence, in many, many headlines across the economy and sectors. This is a theme I know you all have seen in some way, shape, or form. Since the launch of ChatGPT, which was November of 2022, it's actually really interesting. Since that time, AI stocks have driven 78% of S&P 500 returns. So if we're looking at S&P 500 as a proxy for the market or the stock market in the US, that's a really, really big driver in a pretty short amount of time. Likewise, when we look at what percentage or makeup of that S&P 500, how many of those companies are AI related, that percentage has actually jumped from 29% back in 2022 of AI companies. It's now about 50% of the S&P 500. So I think the big story and the takeaway for clients is that unlike prior cycles or tech bubbles, you may remember the dot-com bubble, the tech wreck. Unlike that environment, what we are seeing is that these companies have really, really solid earnings. And we'll go into that in the next slide, but it's something that the fundamentals are really quite strong here. If you look at these hyperscalers, so these are names like Google, Amazon, Meta, Microsoft, and Oracle. Those are your hyperscalers. They have been spending really, really big. We call it CapEx or capital expenditure, the money that they are laying out to invest in this AI race, right? Who is going to have the best solution? Who is going to reach generative AI first and deploy it across the economy? There is definitely a first mover advantage. But again, what is making us feel more confident that this is not a bubble, this is the fundamentals are sound here. It is that the earnings of these companies have actually risen quite closely in line with the share prices. So it's not just hype, to put it that way.
And that's different from the dot-com era where you had companies that were trading on anticipation of, hey, this new internet thing is really going to make them a lot of money, but they weren't making the money to go along with it. So they got detached from reality. I
That's
remember those days well.
That's exactly
I was only
right.
3, but I remember him well.
What a time to be alive. Yes. No, Andy, that's great, great context. And so again, and that's a question that where we sit at Dynasty, we get that a lot from our end clients. For the portfolios that we manage. So again, would like to just say like that has led us into 2026 and where we're starting the year. Um, Precious metals had a really, really, really strong 2025. Surprisingly strong in some cases. You saw gold return 65% in 2025 and silver almost 150%. There have been a couple of drivers of this, of course. The central bank buying, that is what that chart on the right is looking to illustrate, is demand and gold purchases by central banks across the globe. So you're really seeing reserves of gold increase dramatically. There are some, there is a little bit of a fear trade underlying it. I mean, gold traditionally it is bought as a bit of a hedge, but this is not the overall story here. It is not a fear-driven rally. Again, that is something that has been definitely asked about quite a lot. That structural demand. The next trend and theme we would sum up is talking about bonds. So on the fixed income side in 2025, you saw bonds do what we always want them to do, which is provide ballast and provide really solid returns. As we say, bonds were cool again in 2025. So you had about a 7% return on the Bloomberg US aggregate or the AG index, which is just a broad index to measure US bond performance. So you did see the Fed began cutting rates. That was a factor. But yeah, the diversification worked. You generated your income. It's exactly what we want to see. And the last piece we will touch on here, you did see, again, diversification paid off globally. So we know that for many years now, the US has outperformed international equities. But in 2025, largely driven by dollar weakness, you did see international equities outperformed. This was distributed across developed markets globally. So think about your like Western European country, your Germany, your United Kingdom. Those are your developed markets, but also emerging markets. So a China, a Korea, countries like that. There was stronger performance relative to the US driven by that dollar weakness. So, I mean, I think really if you just want to sum it up, the big picture for 2025, AI drove the growth and the returns, but the fundamentals were there to justify it. You saw diversification finally work in your bonds, so your fixed income, in your international equities, and your real assets with the precious metals. So that I hope sums up 2025. And with that, I think the next slide is actually yes, the stock markets and election years. And Andy, I saw you came off mute. Was there anything you wanted to add?
I was just going to remind people to pop questions in the Q&A section kind of as we get into the next section and look ahead as you all transition.
Beautiful. All right. Before I hand it over to JC, I think, yeah, we'll just touch on stock markets in election years. As you all may be aware, we are looking at a midterm election year. I think we all have probably been through these cycles in the past, and we do know that yes, volatility does tend to rise in an election year. That, along with all the other reasons that are contributing to volatility, perhaps in markets in 2026, which JC will get into. But the good news, I think, to put this all in perspective, is again the S&P 500 total return. If you look at it in midterm election years, going back to 1933, the average annual return was 8.6%. So it's still really solid returns across the board. And actually, if you take out 2002, so that tech wreck, and then 2008. If you take those years out, so going back to 1933, with the exception of those, your average annual return is 10% in midterm election years. So just want to maybe give some perspective. And yeah, I will turn that over to JC to talk about 2026.
Great. Thank you so much, Denise. My name is JC Kurtzman. I work on the Dynasty investment team, specifically with the portfolio management. So I'm happy to be here to walk you through how we're thinking about markets and working with your great team at Centerline to be a resource and really just help provide more color for all of our tactical views. So to kick it off, I think it's really well publicized. You see on CNBC and the news, there's a lot of talk about high valuations. And while this is somewhat true, if you look at historical evaluations, it doesn't indicate that we're at a top and there's going to be poor returns in the near term. And I think it's important to note because I think there's a lot of media that likes to really emphasize that, but really high PE, which is kind of an indicator of evaluation, does not mean the returns in the near or intermediate term will not be good. The other piece I would highlight is you see on this page, the US specifically, we have higher valuations than other regions. And a lot of that's actually due to the makeup of our index as well. So we have more tech companies, and tech companies tend to have higher valuations because more of their stock price is based on future growth. And so a lot of that higher PE in the US is really just a matter of the index construction. So I wanted to point that out. It doesn't mean we're not watching this carefully because, when you have high valuations, it's more important that companies' earnings are very strong to continue having strong performance. So we are hyper fixated on that, but still cautiously optimistic. Shifting focus over to the labor market and inflation, those are two of the big policy pieces that we look at. So with inflation specifically, we actually have not been super worried about that coming into the year. We're really encouraged to see shelter costs coming down, and shelter is about 40% of CPI, which is the measurement of inflation. So we've continued to see that inflation tick down, which is very positive. The other piece being is that when you hear about the AI trend, it's actually very deflationary. And so we think that will continue to be deflationary and provide some relief on that front. On the labor market side, that's where we're a little bit more focused. The labor market recently has actually had a pretty strong reading, but the broad trend is that it's been weakening and coming down from highs. And so what we're thinking there is, like healthcare, construction companies, those are some of the big industries that are carrying the labor market. And so we have to be very careful because it relies on such a small subset. And so our view is we're not as worried about inflation. We're a little bit more looking at the job market, want to make sure numbers keep coming out good. And then the other piece to that is Kevin Warsh was just nominated to be the next Fed chair. Our view is that he will be more dovish than Jerome Powell has been. So we could see some relief for a labor market that maybe gets a little bit, struggles a little bit from that new Fed chair. I'll briefly touch on emerging markets. So our view is we actually have liked emerging markets lately. We've started to see a really big ramp up, and you'll see on the right-hand chart there of semiconductors produced in specifically areas like South Korea, Taiwan, and China. And these are all inputs to the AI supply chain. So they have really been benefiting from the AI trade as well, in addition to what Denise mentioned about a weaker dollar. So those two factors, we've continued to like this region. Market breadth is actually, it's one of our favorite things to talk about because the last couple of years, we've seen a lot of the performance. Denise pointed out the number, have been really reliant on 7 companies. And we've always been asking, what about the other 493 that make up the S&P 500? And so now we've actually finally started to see performance and strong earnings and broaden out to other parts of the market other than what you've been hearing called the Mag 7, which are those companies like Apple, Meta, Google, etc., NVIDIA. And so that broadening has been very, very positive. And we've actually, this was, our market view for the year, and we've already started to see that broadening year to date, which has been very, very constructive for our view. So, energy, you have sectors like that up 21%, materials also up 19%, industrials, utilities. These are kind of those, we talk about in the AI trade bits to atoms. And so those actually are the physical companies that are going to benefit from spending on AI. So when you think about a need for power, a need for the infrastructure build out, you have to go, buy raw materials. That's benefiting the materials company, energy, etc. So we really like betting on the market breadth versus just a concentrated position this year. Last year, after Liberation Day, we saw volatility really collapse down. And both in the stock market, which is measured by the VIX you'll see on screen, and the bond market, measured by the MOVE. And so, as we see volatility being very, very low, historically, when we have high multiples too, and you're in an election year, we think volatility is likely going to be a little bit higher this year. And then I think the most important takeaway from that is you really, throughout this volatility, to keep that long-term mindset, staying invested, because we've seen become a little bit more plateau in the last 6 to 9 months, but we could see that uptick. And so just keeping in tune with your financial plan and keeping that long-term mindset is very important. We were talking about a couple of the bubbles earlier in the webinar, but did want to highlight this piece. So typically, and we looked at a Bank of America Merrill Lynch study to kind of pull this out. But typically, when bubbles have burst in the past, it's been when financial conditions tighten. So what does that mean? It's when you have a Federal Reserve that is raising rates. Right now, we have a Federal Reserve that continues to lower rates. So we see that as a tailwind to the equity market. And even the consumer, you think about it, the consumer businesses can borrow at lower rates. And that is positive for the economy. So back to valuations again, we talked about valuations, specifically in the US, being a little bit higher. And we did want to pull specifically those AI targeted companies. And really, they haven't diverged all that much from the broader NASDAQ index since, again, the release of ChatGPT in November of 22. So that gives us a good level of confidence that the market isn't making huge bets on these companies. Again, what Denise said, the earnings are backing it up. We're feeling comfortable with where they're trading because of that. This slide is great to just give you perspective of all the spend. Denise talked about CapEx, and yes, companies are spending money because it is expensive to build out infrastructure projects. But when you put it in perspective, the percentage of GDP, gross domestic product, it's really not as high as some of the past huge projects that the US has really built out. So looking at the railroads or auto infrastructure, even telecom in the 90s, were really a much smaller percentage of GDP than that. And so that gives us some confidence that, there's not an exorbitant amount of waste going out there. We talked a little bit about power, but the power theme is going to be an important one for the AI trend, specifically because, our grid in the US was built in the 60s. And so it's, to this point, about 60 years old. So, grids typically last about 50 years, like they start needing to be rebuilt. And we've also the last decade had energy demand just be absolutely flat. But now with the AI build out, it's going to require a lot more energy and general just electrification of our system as we build out more infrastructure and transportation and things like that. Um, so I did also want to highlight it's not just AI. So we talked about even reshoring as, we start building more factories in the US versus in China. That is all going to take more and more power demand. So we really like getting exposure to that theme, which is typically like some industrial companies and utilities. So those are the types of companies that you'll see there. Last piece I'll touch on are banks, financials. So we do like having a tilt into some financials. This administration has been very pro talking about deregulation and letting banks have a little bit more leash, given that they kind of overdid it after the great financial crisis. The other piece that we've seen is extremely strong earnings coming out of these banks, especially in the last three earnings reports. They've been extraordinarily strong, and we could see that happening, plus a multiple re-rating as investors start to think about deregulation and are willing to pay more for these companies. The other piece I'll talk about is M&A. So mergers and acquisitions and capital markets in general have really started to pick up, and we see that as a positive for banks and financials specifically. So I'll turn it over to you, Andy, after, and obviously I'll give you some time to touch on this one too. But the last thing we really wanted to hit is really the value of staying invested and throughout volatility, not exiting the market. Your financial plan works when you do that versus getting out. And even when I know we talked about our outlook being that there's going to be more volatility, just knowing that and knowing you're diversified so that you don't need to necessarily worry and sticking through the plan.
Yeah, that's right. And again, we want to encourage people to pop questions in the Q&A section. We've got a couple coming in here. But Jeff and Jack, maybe take a turn at explaining why when we build a financial plan, it already accounts for dislocations in the market, and maybe a little bit about why the plan maybe doesn't work so well when we deviate from a diversified portfolio that we buy and hold.
Yeah, absolutely. So the way the plan is constructed is, I mean, really what we're taking is a much longer view than what we're looking at, for instance, today of just 2006. So, the average plan is going to take more of a 50-year view than a 1 or 5 year view. So that's really important considering these trends are kind of things that come and go, and a lot of times they're cyclical, but they're going to maybe rhyme with each other, but they're not always going to repeat in the exact same way, in the exact same sequence. So what we look at is proper diversification. We look at high quality investments that are well diversified for just that reason, because as certain opportunities may present themselves, well, that might come with a different set of drawbacks for other types of assets that are either in different locations geographically, or maybe they have different political risks. There's a whole number of factors that are out there. And as things change, I mean, think back to how different the world was 50 years ago, right? If we look at another 50 years from now, it's impossible to really see what's going to happen in the future. So the best thing we can do is cast a wide net with high quality diversified portfolio so that we can capture the best opportunities that come and also blunt any of those downsides that may come as well.
Yeah, very good point, Jeff. So all these things are planned for. Going back to the slide of, just the value of staying invested and just looking back, just last year, we went through that. So if you looked from, February to the April lows of Liberation Day and tariffs, and the market was down, I think the S&P was down 21% in April, in the lows of April. And by the time July got around, we were back even to where the S&P was at. So short-term volatility like that, although it is scary and it is, no one wants to see their accounts in the red, making decisions to move to cash or try to time the market in that situation, wouldn't have worked out in the best.
Yeah, I mean, I've been through this so many times in my career. There's always a reason to be scared and kind of want to change your trajectory, but really the trajectory changes should be made when you're calm, when the markets aren't seesawing, when you're not afraid, when you can really evaluate how much risk should I be taking at my age? What am I trying to achieve? And that's what we try to do in our financial planning sessions is walk through those parameters so you've got the best chance of getting it right in the long run. And we all have one chance of getting this right in our lifetimes. And fortunately or unfortunately, we're set up. In the old days, you worked for the same company for 40 years, you got a pension, you lived maybe 5 years if you were lucky, and you didn't have to worry about stock market volatility and running out. But now we're in a system where the good news is we can pass that wealth on to other generations if we create it. The bad news is we kind of have to create it and maintain it. And that's why we don't go to our families and say, hey, we think you should put all your chips on the red square and roll the dice because we could double your money this afternoon. But the problem is if your number doesn't come up, we lose all the money this afternoon. That doesn't seem like a very good plan. So the only thing that we've found that works for families in the long run is to build this diversified portfolio, high quality assets, measure the amount of risk, see how that fits in with your financial plan. Does it help you achieve your objectives? And then stick with that through good markets and bad, and then only make adjustments when you have inflection points. I've retired. I'm not saving as much. Do I need to dial down the risk? Well, let's talk about what that looks like and what that means for your plan. It's not about trying to earn the highest return. If we were going to do that again, we would just put it all on one thing. But that really gets into a gambling mode, and we're not gamblers here. We want to take risk. We want to take the appropriate amount of risk, but we don't want to step into that gambling world. If you want to do that, take $5 and put it on your favorite horse. Take $5 to the casino and put it all on that red square, but don't do that with your life savings. All right, maybe we pivot, guys, to we've got a couple questions in the inbox. Maybe let's really put JC and Denise through their paces and try to stick them with some tough questions here. Jack, you're on mute.
All right, sorry about that. Here's one question here. One question's asking about gold and silver. Performed well in 2025. How do we see that fit into the portfolio going into 2026?
I love this question. So, yes, gold had an extraordinary year. And, the slide Denise had up earlier really talked about why that is, and central banks around the world buying more and more gold rather than US dollars. And so we think that trend will likely continue going forward. Will it have another 65% year? No one would know. That being said, we think there's a spot for it, right? We fund it from fixed income, so it's a very smaller calculated position. Gold is less correlated to other parts of the portfolio too, so it's a really nice position to put in for just a small little diversification piece.
Great. Great insight there. Another question that's on here, it went back to when Denise was talking about the AI theme for 2025. The question is the AI trend still in its early stages, or where do you see AI currently being at?
It's a good question. And Denise, I'll let you come in too. I think we're in relatively early phases. If we think about when ChatGPT came out, and even relating that back to the late 90s and early 2000s and how long a cycle really is, feels a lot shorter when you're in it. But ChatGPT, November 2022, so it's been a couple 3 years now. We're starting to see a rotation within the AI theme, which I think is the more interesting part because the same companies that win at the beginning are not going to win the entire decade, right? And so we're seeing this transition to the physical parts of AI. So I talked about broadening, but really that's a big piece of it. Some of the materials companies, industrials, energy, and we see that as positive. And lately, you've seen software, especially, get hit really hard. AI is going to disrupt all of technology, but I think our perspective there is we have an opportunity to then create alpha, and we choose the right managers to help us do so. So that's our take. We don't know. We don't have a magic ball, but we're probably early on is how we're looking at it.
And I think it's actually really interesting. We have looked at looking at performance of this like AI basket of stocks relative to if we go back to the tech bubble, early 2000s and the introduction of Netscape. If you look at the introduction of like the first internet browser, you think about Netscape isn't even around anymore, but they've actually followed really, really closely in line. So from the ChatGPT launch and the introduction of Netscape, while they're in totally different timelines, this first 3 to 4 year period, it's actually really, really closely in line. And I bring that up as it's just something to say again, like the introduction of these new technologies, the adoption, that tells us that it's still pretty early in the adoption. And to Jeff's point, it might rhyme. It likely is not repeating. History doesn't repeat itself, but sometimes it rhymes. So yeah, we do think that as you continue to see across the economy, those numbers are just starting to pick up as far as workers reporting their usage of AI on a daily basis. So it was interesting. You saw at the enterprise level, companies across the country in all sectors were paying for licenses for like a Microsoft Copilot or a ChatGPT for their workers. But the self-reported use like of workers saying, yeah, I'm actually using this on a day-to-day, it was really low. Like it really lagged for a while. And then that has just recently started to significantly pick up. So yeah, I think I definitely think early stages, it's just going to continue to lead to increases in productivity, not necessarily, job elimination in a lot of ways.
Yeah. Great. Let's see here. Jeff, are you seeing anything else in there?
Yeah, actually. So I got one that just popped up here. So we've seen a great amount of focus on the Fed, in particular the new chair, Kevin Warsh, whom you mentioned. Please take us through the basics of when hawkish is good in the market and/or employment, and when dovish is best. Again, the fundamentals would be helpful here. It's a hot topic these days.
Great question. And yes, it is getting a lot of mentions. So when we think about like taking a Dynasty uses kind of 4 prices that we look at that will give us a risk on or risk off signal. And one of those is actually interest rates. So lower interest rates are typically, or lower or lowering interest rates is typically a little bit more risk on for the stock market. And raising interest rates, it can be a headwind. So if you think about it, when, inflation starts to really kick up, that's when you have to raise rates. What's a little counterintuitive about that is a healthy amount of inflation means our economy is growing really strongly and doing really well, but not too much inflation. And so that's where when we start to get inflation ticking up too much, like we did back in 2021 and 2022, that's when you see the Fed have to start raising rates. And the market sometimes does not like that, especially when it's fast. I hope I somewhat answered that, but dovish is you're going to have a good market potentially in both scenarios, but typically if you think about lower rates being more risk on for stocks because of that lower borrowing cost and the way that we value companies.
I would say too, there is a pattern. You can go to past cutting cycles when the Fed is supposed to be balancing two mandates, right? Which is achieving target inflation of 2%, and also maximizing employment or minimizing unemployment. So the rates are, of course, the one of the biggest tools that they use to affect those two goals. But in past cycles, when the Fed cuts rates, if it is in response to, say, a recessionary environment or an environment where they need to make it ease, right? Make it easier to lend, to borrow, so people can spend money, so people can help contribute and drive the economy, right? The market sometimes reacts a little negatively when rates do get cut, if it is in response to, bad conditions. So I say that to say, JC, it's a really good thing to point out that some of it is a little counterintuitive, at least to me. But regardless, sometimes you do have some bumps in response to the immediate policy decision, whether hawkish or dovish. But, we do continue to see they achieve the long-term goal that they're seeking, whether that's easing or tightening.
And I would just add one more thing on too. It's like when you see inflation being relatively tame and the job market being tame, then we're not seeing as big of reactions from either a hawkish or dovish Fed.
Maybe just as an add-on, what is your opinion? And not, I know it's a little bit of a hot potato. We're not trying to do that, but just there's a little bit of a push lately to make the Fed less independent. I think the Fed has mainly been independent since its creation in 1913, if I have that year right. Just in your view, what does that do if it's less dependent? In other words, if the Fed is more beholden to the political winds of either party, really, what then happens to the markets, to the signals that the Fed sends at that point? Do you all sit around and talk about that very much?
We sure do. I mean, we just had our investment committee yesterday, so this is a frequently debated topic. But I think the biggest thing to point out is the Fed in general is a committee. So it's really not one person that is making these decisions. There's a whole committee of people. And typically, historically, they've all kind of voted with the Federal Reserve chair and what he or she has chosen to do. More recently, we've started to see that committee have a few people who disagree. And so I think I wanted to lay that out as kind of the preface there, that even if we have a Federal Reserve chairman who is, say, less independent, we still have that as a backstop. Going into your actual question here is, I think what we would see is higher rates for longer term borrowing. So what we would call that is a steeper yield curve. So we're going to see investors who are investing in the U.S. economy via our debt, they're going to demand to pay more for that because they will see it as somewhat riskier. So that's one of the pieces I would highlight as a threat from the Fed losing independence. But our base case is that the Fed remains strong and they have a committee approach and the Fed remains independent.
I see. So the Fed could be pressured to lower short-term rates, which is really the only place it can kind of directly affect it. But because investors in debt are less certain about the reasons for that rate cut, they demand more, and so the yield curve it actually could have the opposite effect on things like mortgages. It could have the opposite effect on things like the U.S.'s ability to um, re reinvest or recycle its debt structure to keep its debt structure. So in other words, we may pay more in hard dollars to sustain $38.5 trillion in debt, ironically. Okay, so it's like everything is counterintuitive and inside out where you think it is or it's not. If I lower short-term rates, great, that might help this segment of the economy, but longer term rates rise, it makes mortgages more expensive. long-term debt and the country's debt more expensive to service. Interesting.
Exactly, because the Fed really, they borrow to fund our deficit all across different maturities. And so it will help at the short end, but as you keep going further out, it's going to make it more expensive.
All right, great. Well, I think that's all the questions, unless anybody has one for the last minute here. Otherwise, we definitely want to thank Denise and JC for their time and putting together this presentation and keeping us on track. We appreciate the partnership and thought leadership that we get to share back and forth on all of this stuff. As all of our attendees can guess, we're a bunch of market and economic nerds here, so we could probably talk about this all day. But we want to thank everybody for attending. Hope you got something out of it, and we're always around to follow up if there are additional questions. Thanks again to both of you.